let's bring in the one, the only Joseph Wang. Good morning, Mr. Wang. How are you today? Welcome to the Face Show.
Hey, good morning. Can you guys hear me?
Yes, we can hear you just fine. It's so good I haven't talked to you in person. I think it's probably been almost a year. And I want to say things have changed a little bit over the last year, wouldn't you say?
Oh, yeah, I would say that. A lot of things happening right now. It's quite an exciting time actually in the markets.
It is a very exciting time in the markets, and Joseph, I just want to say, I'm a big fan. I've been a big fan for several years now, and always love having conversations with you and talking about everything that's happening in the markets. So thanks for joining us today. Dale is he's back in Chicago visiting a friend. He said you were going to be coming, so I was super excited about having this conversation with you today. So once again, appreciate you being here. Let's talk though about, and I want to ask you about obviously interest rate cuts. I want to talk to you about this global phenomenon where you're seeing Bank of England today jumping on the rate cut bandwagon, and it seems like we have this now coordinated effort. Even the RBA might be cutting rates soon too. But I want to get your thoughts on how far we can go. How far do you think the Fed can go amidst everything that's happening geopolitically and port closures and, is inflation really dead? So there's so much to dig into. But let's start with cuts. I mean, how do you feel about where the Fed's at and where other central banks are at right now?
So like you mentioned, we're in a global rate cutting cycle, and I think that so far that's been pretty supportive of the markets. I mean, as the market participants have seen over the past few years, rate cuts are positive for asset prices. Now, one thing that I think is really interesting in looking at all this is that we have this global rate cutting cycle. And so, in a sense, interest rate differentials are not really changing all that much, let's say US compared to other countries, with the exception of Japan, which we can talk about. And yet, at the same time, over the past few months, we've seen the dollar weaken significantly. So, one of the things that I've been thinking of is one of the drivers of currency weakness or strength going forward might be less about interest rate differentials as we all kind of move lower, down, not towards zero, but just lower in the global rate cutting cycle, but maybe the fiscal situation. Now, compared to other countries, the US's fiscal situation is notably worse. Now, the IMF actually has a fiscal monitor. That's something they publish twice a year. And in it, they have a special section talking about their concern of the US fiscal situation, which they forecast to have a fiscal deficit of about 7% a year for the foreseeable future. In contrast, other rich countries have a fiscal deficit of about 2% for the coming years. So, at a high level, if you have a large fiscal deficit, you're basically printing more of your currency, and that is not good for the currency. I think that's something we see throughout the world, oftentimes more obviously in emerging markets, but if you behave in that way, I would assume something similar happens to your currency as well. So I think that might be one of the reasons why we've seen this significant depreciation of the dollar over the past few months, even though, Fed just kind of cut rates a bit. Now,
Yeah.
the trajectory of the Fed cuts, I think the market is being a bit aggressive on that. So the market is pricing in, let's say we can be around 3% at the end of next year. That doesn't seem to make sense to me. I think that there's a couple of things that suggest that the U.S. economy is doing better than that merits. So we have all this, again, employment is slowing for sure, but if you look at, let's say, GDP data, it's been revised higher. So it doesn't seem like we justify that level of emergency cuts. But more importantly, if you have a significant fiscal stimulus, fiscal spending, that's supportive of the economy, right? You're basically printing dollars, buying it, using it to buy goods and services. So that I think puts upward pressure on nominal growth and inflation. Uh, Again, it's a very muddy picture, though. We do have these port strikes and geopolitical risks that you mentioned, but and that keeps me from shorting, say, the 10-year or something like that. Uh,
Yeah.
but I think that the market is being a bit aggressive with the amount of rate cuts it's pricing in. But it's something we've seen, I think, pretty commonly the past few months. I remember in January, we were pricing in 7 cuts for this year. So far, we've just had 50. So the market has a habit of pricing a lot of rate cuts. But so far, I don't think that I don't think what I see justifies such an aggressive path of policy.
So let me ask you this, Joseph, and you're right. You know, markets always they overshoot or undershoot as far as expectations go. Right now might be a bit of an overshoot, you know, because they just assume that the well, where's the Fed nominal rate, would you say, at this point?
I mean, we're 5%.
But what they view as
Oh,
their nominal.
okay. So I think that my best guess is somewhere around 3.5%
Okay,
would be where I think we cross the boundaries between being restrictive and accommodative. I
okay,
think the Fed themselves right now, the dot plot suggests the median Fed participant thinks it's about 3%. Again, there's some variation there though. So the median participant, actually, if you look at their SCP dot plots, one of the really interesting things is that over the past couple years, they've steadily revised higher their expected neutral rate, and so that's been trending higher steadily, and that reflects the realization that hey, we hiked to 5.5%, and yet we still have very strong GDP growth, yet markets are at all-time highs. Maybe something's different today than before the pandemic. So if the Fed is at 3% and it's been going up higher, I think it neutral about 3.5%.
got it. Okay, all right. So that's where the Fed might see as more of their where they should be. And but everything that's happening this year, is there scope, or you know, I say everything that's happening. We still have so many things that are happening by the end of the year, especially with this election, and you know, this port closure, which happens at a very unique time for it to happen. Do you think that that's going to have a huge impact on the U.S. economy over this fourth quarter?
So what I understand from that is from what I read in the news articles, it sounds like, and there are people in the industry, I think Craig Fuller is on Twitter is one of the people in the industry who's been talking about this, is that it's probably going to have a pretty big impact because it's not going to be easily resolved. It seems like the two parties are quite far, and at the moment, it's really hard for the White House to intervene to do anything. On the one hand, if you know support the businesses, force the people to call off their strikes, you know that would be good or bad for good for the economy. But on the other hand, that'd be really bad for the election because you would be, in a sense, standing against the workers. Now, it seems like the impact of this on the economy doesn't really happen until some weeks later, and so that is after the election. So I think this is something we're going to see for the next few weeks. Probably nothing is going to happen with this strike because of the politics. Maybe something will happen after the election, but by that time, the damage has already been done. And so I think it will have an impact on both the jobs numbers, which I think will upset the market, uh, and also the economy, since there will be shortages in some sectors. But I think the much bigger impact, though, right now is just what's happening in geopolitics. I
Yeah.
think there's a lot of indications right now that um, so the White House seems to be giving Israel a free rein to do whatever they want. Again, they're scared to do anything to upset Israel heading into an election, right? As we all know, the uh, Congress in the U.S. is beholden to a lot of these Israeli donors or pro-Israel groups, and so they can't do anything until after the election. And I think the what's happening is that from what I hear from many sources, is that Israel views this as a very rare opportunity to achieve their goals. I think Jared Kushner has a long post on X. He's very plugged into that world. They will have a window of opportunity here to achieve all their geopolitical dreams of, fighting Hezbollah and maybe also destroying Iranian nuclear facilities. So they've been, again, doing provocative things, getting also some retaliation, but now they have, I think, the support of the White House and ready and willing to really escalate this and achieve their geopolitical aims. And I think this is not done yet. I think the not, worst is yet to come. And I think that's a reason for significant caution. That's going to have a
Mm.
bigger impact on the markets than this strike, which is still significant. But like I mentioned before, from what I hear, the damage doesn't really occur until a few weeks later.
Joseph, you do some trading on your own, and that's one of the things I love the fact that after you left the Fed, you get you manage your own money, you do a lot of trading in the markets, and so this is going to be a question that is going to have to be an opinion of yours, but it's something that I think we need to be thinking about in light of everything you're saying. We haven't been in a period of risk aversion in quite some time. And here we are with the S&P up at all-time highs and perched right at all-time highs, which typically is not a very bearish event. However, as you're pointing out, there are a lot of risks. In the past, we've seen your traditional risk off type of trades manifest gold rallies, which gold is near all-time highs as well. But would the dollar, and I'm asking you, as more of your opinion on the dollar here, and maybe other currencies that could benefit in the event that we see some risk aversion in the markets, where would Joseph Wang be looking to park money from a risk aversion point of view? What are your thoughts?
Uh, so I, so yes. Over the past week, we've seen you dollar getting a risk off bid, as we've seen consistently for many years. We've also seen gold go up. That's often a response to geopolitical risks. Although, of course, if we do have really big downside, uh, that gets sold off for liquidity as well. I personally, the way that I'm positioned, I'm short futures, I'm long puts, and I'm long gold, and I have a lot of cash, and that's really all my positions right now. So I'm really cautious. I do think that we go, there's a good chance that we can go meaningfully lower, um, given of all the things that are happening. Um, but on the other side, as I understand, after the election, we also have good seasonal effects and so forth that could be supportive. But right now, I think actually I'll give you a bigger macro view. Actually, why I'm super cautious. In addition to these, I think near-term things involving risk in the Middle East and strikes and so forth. In that, I think that what is happening is that we have a good chance that we could have a pretty major sell-off in for a few quarters because of what's happening with the rates and currencies. So the Fed is going to cut rates, and if we have downside from war, if we have downside from the port strikes, causing unemployment to shoot up and so forth, we could have a more aggressive rate cutting cycle. Now, this is happening in the context of significant fiscal deficits. So I think that there's some chance that we could have a meaningful depreciation of the dollar in the coming months. Again, 7% fiscal deficit, that's not normal. That is emerging market behavior. So one other thing that happens in emerging markets is that as the currency depreciates, the foreign investors, they get out. So they sell their foreign currency denominated assets and they get out because they don't want to take losses on the currency depreciation. Something similar could happen in the US because foreigners right now actually have very high exposure to US assets. I own about 20% of US equities, also a ton of treasuries and corporate bonds as well. US, obviously, world's deepest and most liquid capital markets, also the home of many popular things like AI. So a lot of foreign investors are heavily allocated to US assets. If we do have rapid dollar depreciation, which may not happen. These geopolitical risks are supporting the dollar right now, but beyond that, 7% fiscal deficit, aggressive rate cuts, that can't be positive for the currency. And so you could have this loop whereas foreigners lose money on the currency side of their US dollar assets, they sell, causing other people to sell and so forth. So that I think is a risk that's really keeping me from having a big exposure to US assets right now. Also, I want to wait until the election, of course. For all I know, we could have a Republican sweep. Trump really likes to have tax cuts, really likes to, boost the
Yeah.
stock market. And of course, foreigners perceive Trump to be good for the economy. Although Trump has been saying he wants to depreciate the dollar, I think the market, just based on what I've seen, seems to link a Trump win with dollar strength, simply because he's perceived to be more positive. So that could change everything. So there's a lot of there's a lot of things happening right now. We've got geopolitical risks. We got this big structural dollar weakness due to deficits that I'm talking about, and we also got the November election. Three things here that I don't think I'd feel comfortable having a lot of long exposure until, at the very least, at the very earliest, until after the election.
All right. Well, that's a really, really great answer, Joseph, about risk averse, and it's interesting to hear your views on the dollar too, as we head into the latter half of or the fourth quarter of this year. I wanted, so, well, you touched on this, and before we wrap things up, I did want to kind of circle back to other central banks and maybe more specifically what's happening in Japan because of this new prime minister. He's obviously caused a very big ruckus in the dollar yen and,
Yeah.
and in the yen in general. And oh my God, it's like, yeah, I actually thought that I wasn't sure if Takashi was the one that actually got elected based on the yen reaction over the course of the last few days. But tell us a little bit about A, the yen, but B, other central banks and kind of how you're seeing it right now.
So the yen, the Bank of Japan is the one huge developed market central bank that is bucking the trend and actually hiking rates. There's actually so one of the Bank of Japan board members gave a speech, I think 2 or 3 weeks ago. In it, he has a really good. Okay, what's awesome about the Bank of Japan is that they actually publish many things in English. So they're thoughtful about people like us who don't speak the language. But they have this really good chart about where they think the neutral rate of interest is in Japan. And so that's very difficult to observe, but they do like I think 4 or 5 model estimates of where they are. And their finding is that the neutral rate of interest in Japan, according to all these 4 models, is low. But here's the thing, their current stance of policy, where real rates are right now in Japan, is below all of those estimates. And so they're saying that inflation is above our target and our stance of policy is below all the estimates of neutral rates that we have. And so we
Wow.
got to hike a little bit to make sure, at the very least, we are at neutral because inflation is above our target. So that's the way that they're looking at this. We got to hike rates, we got to normalize policy because we're still being too loose and inflation is above target. So that's their perspective, and that's why they've been trying to hike rates even as we had a bit of a hiccup in August.
Yeah,
Now,
but Ashiba said that, and he said this publicly, over the last 48
okay,
hours, that he doesn't think the Bank of Japan
let,
should be raising rates.
let me
So
let me get to that, right? Okay,
okay.
so that's the Bank of Japan.
Yeah,
And as we know, that's just one side of the story. We have the political angle as well.
sure.
So now we have this new prime minister, and the market's first reaction was that what was pretty hawkish, right? Because the thinking was this guy would allow Bank of Japan to normalize rates. Now, as you rightly note, we have headlines coming in recently that, hey, this guy is saying that the Bank of Japan shouldn't hike his, or maybe he's dovish. So we have that strong reaction in the yen, where GUSD JPY is going up, Nikkei is going up. So it seems like the yen and Japanese assets very sensitive to the path of policy for the Bank of Japan, and maybe the prime minister is, just going to force the Bank of Japan to back off. So if that's the case, then that USD JPY could go much higher, and that would be very risk positive for what's happening in Japan. But I just don't know enough about the relationship between the Bank of Japan and the government there to say that who would win in this kind of dispute. So I give you the perspective of the Bank of Japan, why they think they should hike rates, and we've heard from the new prime minister that he doesn't like that.
Yeah, it's interesting and I was talking with Chris Weston from Pepperstone Securities, the head of research over there, last night, and he's like, yeah, I just don't like it when you have these you have politicians that are trying to meddle in what needs to be a more central bank decision. So it's going to be interesting to see how this unfolds, Joseph, especially in the very near future with a new prime minister and with the Bank of Japan probably going to be at odds based on what you're saying. So as we wrap things up, Joseph, last question for you. currency wise, where do you think is going to be the best place to be positioned over the course of the next, let's call it several weeks as we try to navigate through this very, what's probably going to be setting up to be a very volatile time over the next 4 to 6 weeks? What do you think?
I like gold. And
All right,
so
the yellow metal currency,
yeah,
yes.
I mean, listen, we got again global rate cutting cycle as you mentioned, Blake, and also geopolitical tensions. That, from what I read, the worst is not yet here yet. So that's I think that's very supportive of gold. So yeah, that's why I think we have this huge surge upwards. Looks like we're taking a breather for a couple days, but looking at the trend, it looks like it wants to go higher.
It's hard to say it's bearish when we're sitting at all-time highs. So I can't
Yeah,
disagree with you. I have to agree with you there, Joseph. Well, Joseph, like I said, and just for the record, and for those of you that are like, oh, Joseph sounds pretty smart, but you know what? He's very market savvy. If you go to the beginning of 2024, I think for a good month, you were out there running around the Twitter sphere and the YouTube sphere saying, hey, the stock market's going to crash up. And
crash up. Yeah.
we've had nothing but that, Joseph. If you look at the beginning of this year, in 2024, when you were running around saying that towards the end of 2023, I would argue that at this point in time, the stock market is up at least 20%. So you have been deadly right. It has been nothing but a crash up. So very well done. What's the best way for traders to follow your work?
Yeah, so I'm on Twitter, FedGuy12. You can also check out my website, fedguy.com. I post weekly commentary on that site. And I also, if you guys, this might be a bit too basic for you guys, but I also do weekly market recaps on my YouTube channel, Joseph Wang, where I talk about three things that I found the most interesting in markets every week.
Oh, that's pretty awesome. I actually try to watch your video right after I finish my week ahead video that I do, because I think it's you cover those 3 topics, and I'm like, man, I should have talked about that. But you're always nailing like what is moving right now. So I posted in our chat box, Joseph's Twitter handle. So if you don't know where to follow him, you have that information now. And Joseph, it's been a real pleasure to have you here, and I'm going to be reaching out to you separately to have you on Traders Summit so we can dig a little deeper into some of these charts that matter. Maybe towards the end of the year. So I want to thank you so much for spending your time with us. I know it's super valuable to you, and for our listeners at home, I know it's very valuable to hear your thought process here. So thank you so much.
No, thanks so much for inviting me. It's a pleasure to be here. Guys, happy trading.
All right. Thanks, Joseph. And if you guys haven't followed him, make sure you do that. And guys, remember tomorrow, live non-farm payroll reaction, instant reaction. We're going to be navigating through the markets then. So I'll see you in about 23 and a half hours, maybe closer to 23 hours from now. Thanks, everybody. Have a great one. And thank you once again, Joseph Wang. You are wonderful. Thank you. Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.